Hey guys, this is Hutch with BankingTruths.com, and today I'm going to give a very detailed answer to the frequently asked question of, can I build my own bank with something else besides life insurance? And quite directly, the answer is yes, but we're going to explore some of the downsides to asset classes such as stocks, bonds, funds, and this could be mutual funds or ETFs, which are exchange traded funds, and last, savings vehicles. And this would be everything in terms of CDs, money markets, high yield savings accounts, etc. And the perception is if you use any of these vehicles, the mortality charges that are associated with getting a life insurance contract would go away. And by doing so, you would hopefully get a better rate of return or overall yield on using one of these other banking vehicles. I think what you're going to find, however, at the end of this video is that life insurance has some unique characteristics in the departments of growth, safety, or lack of risk, and very importantly, taxation. And specifically, the lack of taxation can more than make up for the whatever mortality charges are incurred with the life insurance. And really, a skilled practitioner is going to know how to reduce these mortality charges to the absolute bare minimum and still retain all of these favorable characteristics. So if you've watched any of my prior videos on banking, you know that this is the ideal we're looking for. And what we're trying to do is we're trying to accumulate assets in an account that's going to give us steady and consistent compounding over time, and will also give us the right to borrow against the account so that as we pay down the loan against the account, we end up at a higher place in line each and every time. This is the ideal. So if we apply stocks to this model, what I can tell you is most online brokerage accounts will actually give you the right to borrow against these funds at any time. And this is called a margin loan. And how it works is as long as your stocks go up, and they could go up at, say, a better rate than whole life insurance, you're going to be doing fine. The problem with stocks is they go up, but they also go down. And there's a saying that stocks tend to take the stairs up and then the window down. So when things get bad, they get really bad. And nobody knows exactly when that will be. So if this does ever happen to you when you've borrowed against your stocks, you get something called a margin call, where they say, we expected you to have a certain amount of equity and it was fine when things were going up, but now that the value of the stocks have gone down, you need to maintain that certain level of equity. And so we need you to put more money into your account, or you need to sell some of the stocks you have to satisfy this margin call. And so that could create some real problems. And I think you'll understand why as we look at the history of the major market indices between 1999 and 2014. And specifically, we're going to look at the S&P total return, which is the 500 most reputable U.S. stocks, including all the dividends that were paid. And the reason why I chose this period is because in our recent past, we've experienced some of the best of times and some of the worst of times in the S&P's history. Starting with 1999, you can see we had this rip-roaring 21% return, and regardless of how much you had invested, you were feeling pretty good when a dollar turned to a buck 21. And that was pretty short-lived, because the next 3 years you can see we had these three negative returns, which brought our dollar to $1.21, $1.10, 97, back to 96. And even though we had this nice snapback rally in 2003, you earned the 28% on a smaller number. So you just got back to 97 cents. You weren't back to even, much less back up to your buck 21. And we continued to have good returns for the coming years. And that brought our 97 cents to 108, 113, 131, 138. And then 2008 happens. And even though this says negative 37%, that's from January to January. If you look at peak to trough, it was actually a loss of greater than 50%. Regardless, the $1.38 turns to 87. And then with all the quantitative easing in 2009, 10, 11, 12, and 13, and also 2014. As soon as I scroll down, you can see our dollar ramps back up considerably, so much so that at the end of this period in 2014, our dollar has turned all the way to 226 after this 16-year period. Now, I do want you to note there's two rates of returns here. There's the actual rate of return and there's the average rate of return. And this gets down to what's known as the flaw of averages. So averages, all they're doing is they're taking these 16 returns and they're dividing that by 16. And that gives us 7.03, which seems a lot better than 5.23, which is the actual rate of return, or the IRR. And what that says is you started with $1, it turned to 226. Let's divide that by 16, and really you only earn 5.23%. So anytime you hear our funds beat the Lipper averages, the S&P average this, just remember that you can't go into a supermarket and you can't spend this average. What really matters is this actual rate of return, and the sequence of returns when these returns happen actually matters. So what you're looking at here is two different accounts, each funded with $100,000. Let's just say with the blue account, you've built up your own personal bank into an account that steadily compounds at 5%. And what the black line is you built up $100,000 in stocks that fluctuate. And it's the same 16-year period from 1999 to 2014 in the S&P total return. And if you remember that 21% return, that's why the first year the 100,000 jumps up to just over the 120, and your 5% account is of course right here. So let's just talk about this and how this would look in terms of banking. First of all, had you been borrowing against your stock account here, you would be getting a margin call shortly after that, and you'd have to liquidate some of your stocks when they're down. Now, had you just borrowed against this account, you can continue to do so. And one of the best times to borrow against your own private bank that's consistently compounding is when things are down over here. So this is some of the best times to get fire sales on real estate or businesses or business inventory or whatever it is, right here and right here. And if you borrow against this account and not lose your place in line in compounding, there's really no fear of getting that margin call. And even though the stocks would have recuperated and even gone ahead up here, think of all the heartache and the fact that you probably would have had margin calls against you. Or even right here, we could see, you have only $80,000 of buying power versus 120. And I will say this about margin accounts. Most margin accounts only allow you to borrow against 50% of your value, this 80,000 here, versus with most life insurance loans, you can borrow anywhere from say 80 to 95% of your cash value at any time for any reason. So there's considerable advantages to using life insurance strictly from a growth or risk standpoint, and the ability to collateralize against that at a much better capacity. And let's just keep in mind that if you buy individual stocks, the performance will vary. But historically, buying a fund like, say, the S&P 500 index, which is what this black line is representing, funds have been known to be a little less volatile than, say, buying individual stocks. And even with that, if we look at this, buying the top 500 stocks in the U.S. economy, this is a lot of volatility, going from 140 down to 80 something in the course of a year, or going from 120 down below 80 in the course of 3 years. So just keep that in mind when considering stocks or funds as your underlying asset class to build your bank with. So let's move on to bonds. And for this, we're going to look at the Federal Reserve's economic data and specifically for Moody's Seasoned AAA corporate bonds, which are also known as investment grade bonds. Now, whether you'd use investment grade bonds or high yield junk bonds or municipals or treasuries is not really the point. What we're trying to see is just the history of bond interest rates, which have all tended to trend in the same direction regardless of their actual interest rate. And I think after we take a look at this together, you'll understand why bonds are not the most efficient vehicle to be using to build your own bank. And I'm just going to zoom in from 1950 to 2015 because 1950 was really the lowest point on the historical curve here, with the highest point being in the 1980s, and we've been going down steadily ever since. Now, although we could go a little bit lower, it's unlikely we can get much lower, especially since the Federal Reserve finally raised the Fed funds rate. And the biggest problem with bonds is there's an inverse relationship. So as interest rates go down, and that's what this graph is representing, the yield or the interest rate, as interest rates go down, the price of bonds actually goes up. And if interest rates were to start rising again, which many people think they will, the price of bonds will go down. So, and when I say price, I mean the money you have in the asset. So let's just say you had the same $100,000 in bonds that you could borrow against. It would be great if you bought them, say, here. And even though the interest rates on new bonds went down, the value of your 100,000 would be going up. However, if you buy bonds here, maybe they could go down a little, but if they do go up, if interest rates do go up and somebody else could buy newer bonds at a higher interest rate, that means the value of your 100,000 in those existing bonds will go down. Now, this chart is also very relevant when it comes to whole life insurance because life insurers buy a lot of investment grade bonds. And it's no coincidence that dividend yields, when you look at most major carriers that have dividend history, they look a lot like this. They were in the double digits in the 80s, and then dividends have been going down pretty steadily ever since. However, your cash value, your whole life policy is not a bond. It is contractually guaranteed to go up every year. Now, if you bought a policy here and dividends went down, then maybe your performance only looked like this. Or the inverse of that is if you buy a policy here and interest rates or dividends specifically go up in the future, there's a chance that your performance will look like this over and above what was illustrated. Either way, you can't go backwards. Once you earn a dividend, it's locked in and your cash value is guaranteed to compound off that number by some rate, and that will depend on what dividends are in the future. And of course, one of the biggest advantages of earning money inside a whole life policy, or any life insurance policy for that matter, is the fact that it's immune from taxation as long as you keep the policy in force until the insured passes away. So none of the growth nor distributions will be taxed, as opposed to any of the other vehicles we're talking about, whether you get taxed at ordinary rates, qualified dividend rates, long-term capital gains rates. A lot of my clients are losing anywhere between, say, 1/4 to 1/2 of their growth in the form of state and federal taxation. So a savings account will also offer you principal protection, only it comes with a cost, or really a lost opportunity cost, because the Fed funds rates or rates for safe assets like that are going to be less than 1% and probably will be for the foreseeable future. And even if they do go up, the spread, the rate at which they'll lend against this asset and allow you to compound a savings account at this wonderful rate, the spread, they'll loan you back the money at somewhere, call it between the 4 to 6% range, depending on your credit. So hopefully you understand why permanent life insurance is the most ideal asset as far as building your own bank to borrow against and continue to let the asset compound free of taxation, free of market risk at a very reasonable rate. So come visit our website for even more materials to deepen your knowledge on this subject. Or if you're ready to see what your numbers could look like and how this strategy could be implemented in your life, book a meeting with one of our team members today.